Hello, everybody. Welcome to another episode of Money Matters. I'm your host, Hung Lu. I'm with Cash Property Inc. And today is April the 13th, 2026. So if you're watching this, you are getting the most up-to-date information. So now here's the thing. We are going to be talking about this amazing opportunity to become mortgage free. And in today's society, who doesn't want to become mortgage free, right? Okay, so now before we get into the heart of what that idea is and how anybody who has a mortgage, you can become mortgage free a lot faster than you think. Okay, so we do have a book out that talks about how to be mortgage free in under 10 years. And I will put a link in the description so that you can get a complimentary copy of that. Now, before we get into the heart of the topic, I do want to share, if I can figure out how to share here, an event that is coming up. So this is, let's see, I think it's this one. No, it's not. Let me see here. Okay, so on your screen, you should see the Eightplex Playbook event that is coming up in Vancouver. It's happening in a couple of weeks. This is a panel discussion with myself, Tommy Huong, and Mark Rubelard. I've had the privilege of writing a book with them about real estate strategies. And so I also now have the privilege to bounce ideas with them on this panel discussion on eightplexes in Edmonton specifically. All three of us are doing an eightplex of some sort infill project in Edmonton. So if you are local to Edmonton or will be visiting on April the 30th, then come out to this event. This is free. Okay, and I'm saying that because the value of these types of events is way more than free. Okay, like these events easily can go for like 50 to $100. Okay, so if you're in town, come to this. I will put the link to this event in the chat, and if you are local, please come out and join. Right, so now let's get into the topic about how to be mortgage free a lot faster. So this came up, and I want to say thank you to a couple of close contacts who reached out to me and said, hey, Hung, can you talk about this topic on your next Money Matters episode? So if you have a mortgage, this is something that you're going to want to listen to, because in Canada, if you have a mortgage, it takes you 25 potentially plus years to pay it off. Okay, and we're talking about your primary residence here. But this idea can be applied to your secondary home, like if you have a cottage, if you have investment properties, you can apply this to any property. And the thing was, part of the book that I wrote about becoming mortgage free is that you can actually apply concepts about how to be mortgage free to any debt that you have. So whether it's a credit card, your car, it doesn't matter. Okay, the ideas are still there. So highly recommended that you get a copy of the book. And I'm sorry, I don't have a copy of the book anymore. We gave out like 10,000 copies of the book, and we just have not printed them out again. So today we're going to take this conversation about how to be mortgage free and take it one step up. Okay, so let me talk about this concept of being mortgage free and why, as Canadians, we can't write off the interest that we pay on the mortgage. Not like in the US. In the US, you can write off the interest that you pay. In Canada, we can't do that. Okay, so you'll see this really cool little diagram that was drawn up for me. Okay, and yeah, I haven't validated this chart 100%, but the general idea is here. Okay, so the idea is that you want to pay down your mortgage principal. Okay, and it doesn't matter if it's your primary, your secondary, like a cottage, your investment, okay, all of that stuff. If it's your primary residence, though, the interest is not tax deductible. Okay, so the idea here is to make it tax deductible so that, okay, you can become mortgage free and at the same time find money to cash flow to live off of, and to potentially have money for the next generation, give inheritance or something like that. Okay. So this is something that I learned sort of by accident very early on in my real estate investing career. And oh my gosh, a complete game changer once you understand this. Okay. So the high level here is that it's called the Smith's maneuver, and there's individuals out there that have been trained specifically to help you implement the Smith's maneuver. And if you don't know what that is, do a quick Google search on it. But then the idea is to connect with one of these individuals that have been trained on it. If you need a referral to somebody, let me know. I'm happy to connect you with somebody in your area that can help you with this and help you understand this. I am not a Smith maneuver ambassador because I'm like, hey, you know what? I don't do mortgages for people. And also because I've been doing this strategy for years and years and years. It literally helped me continuously grow my portfolio. And I'm like, okay, well, you know what? Like I'm already doing this, right? And I'm doing it for people I know, like you guys who are watching. So thank you for watching. All right. So the idea is that you want to use the Smith maneuver on your primary residence. And we're talking about the primary residence here specifically because it's not a tax deductible expense on the interest that you pay on your mortgage. With your investment property, that's a completely different story. Highly still recommended that you still do the Smith's maneuver, but we're only going to just focus on the primary. Okay, so one, you want to make sure that you're able to do the Smith's maneuver on your primary property. And to implement the Smith's maneuver, all that means is really you have to go and get a HELOC on your primary residence. Okay. And you might be thinking, well, Huong, I thought we were trying to get mortgage free here. If I go and I take a HELOC out and then I go and utilize that HELOC, I'm not becoming mortgage free. Here's the thing. Give me a second to explain this, because what's happening is that your mortgage is your mortgage. And as you pay down your mortgage, you are becoming mortgage free. But you have all this equity that's sitting on your property, this debt equity, not debt, okay, not money you owe to somebody, but debt as in like rest in peace, dead. That debt equity, you can utilize that to make you more cash to help you pay down your mortgage even faster, okay? So that's one part. But the other part is that once you have this HELOC, okay, this is step 2. Once you have this HELOC, that HELOC, if you go and use it for an investment, whether it's stocks, investing in a business, or buying another real estate property, that interest that you pay on that HELOC is a tax-deductible expense. Okay, I'm going to let that sink in there because that's the first part. If in step 1, if you just refinance to your max amount and you get all this money back, okay, and then you go and you do something with that money, whether it's to buy an investment or not, your mortgage is not a tax deductible expense in any way, okay? You basically take out that equity, you invest that money. Okay, fine, okay? That is a good move, but it's not the best move, okay? And especially if you're already making an investment, what I'm suggesting is take 2 steps, okay? Which is to, instead of just refinancing, tapping out on that equity portion to go make an investment, get that portion as a HELOC. Now you've got this HELOC money, take that HELOC money and go into making your investment. Amazing, right? Okay, so just from doing that alone, you're going to be able to, 1, become mortgage free faster, and you're going to be able to make some extra cash flow. Okay, now the idea around that though is that whenever you make your investment and any of that profit that's from there, you have to pay that back into your mortgage as a principal payment. Okay, so don't miss out on that step. Now here's the thing though, in step 2, once you have your HELOC invested somewhere, that interest that you pay on your HELOC is now a tax deductible expense. Okay, that is like the ding, ding, ding light bulb moment there. Okay, so now this 1 and 2 only works if you're going to do an investment. If you aren't going to do an investment and that investment is not going to make you more than whatever the interest is that you're borrowing on your HELOC, then don't even do this. Okay, if you're just thinking, oh, well, you know what, I'm just going to invest this maybe for 3 months, 6 months, don't even do this. This is something that you need to be committed to doing for several years. Okay, because your mortgage is for several years, and so is your HELOC product. Your HELOC product is going to be for a minimum a year. Ideally, the longer the HELOC, ideally a re-advanceable HELOC, meaning that as you pay down your mortgage, your HELOC room goes up. So as you pay down your mortgage, your HELOC goes up. Okay, so it's re-advanceable. And then every time you pull out money from your HELOC, you go do your investment. When you've got the extra cash and when you're able to pay down that HELOC. Now that amount in your HELOC is always available. Okay, that's the great thing about it, is that you don't have to reapply for it every single time you want it. If you've got 50K, 100K, 500K in your HELOC, oh my gosh, like there's so much you can do with that. Okay, so now, even if you just did those 2 steps, you're so much further ahead than a lot of people with mortgages. Okay, so now let's increase this and ramp it up another step. Okay, so the next step, okay, if you really want to elevate the strategy one more step, is step number 3. What you want to do now is reach out to another individual, okay, because this person is usually different from your person who's going to help you with the Smith's maneuver strategy. This is now a new person, and this person is an insurance person. They will do whole life policy insurance. Okay, now I am not a big believer in insurance. I used to have like a wall. Like the minute you said insurance, I was like, unless it's home insurance, I'm not listening to you. Okay, hear me out here though. Once I realized that there was this insurance policy that could, one, give my kid all the money he needs from the life insurance policy to cover all the capital gains, all of the logistical bills that he's going to need to pay off everything upon my death, to keep the entire portfolio without liquidating anything. I was like, oh, you better tell me more. But then to top it off, the real value on top of all of that is that I actually get access to the cash value of that life insurance policy. Okay, so basically I put in whatever amount of money every single year to that insurance policy, and then that insurance company turns around and gives me cash value for that. Okay, now that money though, I have to pay interest on it. Okay, so now keep that in mind. So you need to now borrow that money, that cash value, take that money out, pay interest on it. So it's money that I put in that now I have to pay interest. Okay, so now if you just stop there, you're like, Huong, that doesn't make any sense. Hear me out. So now I take that cash value and I go and I do an investment, whether it's stocks, invest in a business, or buy another real estate property. I take that cash value and I go and I do this investment. Now that interest that I've paid on that cash value is a tax-deductible expense. Okay, now if you're following me on this, we are now at step 4 here. Okay, actually we're at step 5. Okay, so we invest in an insurance policy. Now I'm saying invest. Okay, it's not just buying an insurance policy and then not doing anything with it. You're investing in the insurance policy, which is step 3. Then you build that cash value up, because it's not a one-to-one cash value. Like if I put $1 into my insurance policy, I don't automatically get $1 in cash value. So you have to grow that. Now, I've been pretty lucky. I've been getting about 50% on a couple of my policies. And then I have one policy where I've got 90 to 95% on my cash value from day 1. Woo! Okay. So you think about it. If I put in, let's say 50 to 100K into this one insurance policy, I get 40,000 back, or 90,000 back, depending on how you do the math there. Okay, I can turn around within a month, have that cash value back out, go and make another investment with it. Okay, so now the thing here is that you have the cash value, which is step 5. Then you go and you invest it. This is step 6. Now, when you invest it, you have to find an investment, whether it's stocks, business, or real estate, that is higher than the interest that you pay on the cash value. Okay. Now, if you're sitting there going, wait a minute, Huong, are you saying you want me to put money into a life insurance policy, then borrow that money out, pay interest on that money, and then go and do an investment? Yes, That's exactly what I'm saying. Okay. So you're not just paying Paul with Peter, like you're actually making your money work several jobs here. Okay. So now if you follow all of this the way I'm explaining it to you, you're not just pulling cash out of your pocket to buy this life insurance policy. You're actually using the HELOC from your primary residence. Get the HELOC, take the HELOC money, buy the insurance policy, take that insurance policy cash value, do your investment. Okay. So now you're not just doing the investment with cash. You're now using your mortgage, using your HELOC, using a life insurance policy. Yes, there's multiple steps. Yes, there's multiple people that you have to talk to along the way to get this set up. Okay. But you're giving your money, one, a tax deductible expense on your mortgage, and two, you're giving your money several jobs. Last week, somebody mentioned something to me saying, Hong, if you go to your 9 to 5 every day, you're actually taking two people to work with you and your money. Right. And I was like, oh, that's actually really interesting. Okay. So let that sink in and you think about what that means to you. Okay. So here's the idea here. Get your mortgage, your primary residence. Okay. Get that going with a HELOC. Okay. Connect with somebody to get a life insurance policy. Figure out what actually works for you and your family here. Okay. Then let that cash value grow. And if you're lucky, then, within a year or two, you will have enough cash value to go and actually borrow against that cash value, pay interest on that cash value, pay interest on the HELOC. All of that is a tax deductible expense. Okay. Now, having said that, you do need to talk to your accountant on it. Okay. So make sure that you are able to write every single thing off along the way. Okay. So then you take out your cash value, you borrow against that, you go and you make your investment, whether it's stocks, businesses, or real estate. Okay. Something that will make you money. Okay. So now it cannot be where you just invest back into your RSP or your TFSA. Okay, or your RESP. So you can't just do this loop and then take that money, that cash value, and invest it into these registered things. You can't do that. Okay, it has to be one of those other companies or stocks or real estate. Okay, but here's the thing though. Once you do your taxes and you write off all those expenses, any of the positive net cash flow that you have, one, pay down your principal mortgage. Perfect. Okay. And that's where you might look at saying, hey, you know what? Is it better to pay off my principal mortgage or should I be topping up my TFSA? Okay. And if you can do this system, you may want to make sure you're topping up your TFSA, because if you understand this, then you should be able to make a really good return on your TFSA. Okay. Then you let your TFSA compound and grow that and don't even touch your TFSA. Okay, so now that's another conversation. Okay, so now once you have your tax deductions and you can reinvest this, right? This is the repeat and compound, and you go back into your number one. Okay, this hands down, if you can understand this, this will help you, number one, become mortgage free so much faster. Okay, but you also have to take into account the double up payment, the lump sum, all of that stuff that your bank offers you. Okay, go through this entire system. Okay, so now you might be thinking, well, Hong, can you give us some numbers here? Okay, well, the thing is, yes, I can give you absolute numbers here so that you can run through your scenarios. That takes longer than the 10 minutes that I'm targeting to be with you on this session here. So if you want to run your numbers specifically for your situation, just reach out to me. I'm happy to run that scenario with you. And also, you do want to run through this scenario, one with your mortgage agent, okay, then with your insurance policy broker, then with your accountant. So there's three people that you have to sort of talk to along the way to make sure you understand this, okay? And then you also will, of course, need to have, your real estate advisors, your lawyers, blah, 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 all across the way, especially when you're doing this invest and grow portion. Okay. That is what I have for you today. Now, as you can see, I am super passionate about this because this strategy, hands down, will cut your mortgage years, like your amortization years, in half. Okay. Once you pay off your mortgage, oh my gosh, now you can sleep at night without worrying, without stressing about finances. Okay, so that is what I have for you today. My name is Hung Lu. Okay, please feel free to reach out to me. And just a reminder, if you are in Vancouver, please do hop out and join us for our Wealth Development Network event coming up as well at the end of the month. Okay, thank you, everybody. Have a great week.